by massive execution risks.
The market is penalizing them for that lack of focus.
I think the
Terms and securing a monazite permit from an unproven
Looming over the equity. It is, by all technical, we have to unpack the uranium operational breakout they just.
You are pricing in flawless execution without stopping to deep clean it.
Is this stock overvalued or undervalued? Could this stock gain 100% until the end of the year? Stay until the end of the video and to know the answer.
Energy Fuels Incorporated, trading under the ticker symbol UUU. Right now, we are looking at a stock sitting right at the $19 level. It is carrying a high beta of 1.51, and for those tracking the broader markets, that means it's moving about 50% more aggressively than the S&P 500. We are also seeing realized volatility that frequently exceeds 90%.
It's wildly volatile.
Exactly. It swings heavily. But when you step back and look at the market action, you see a massive 387% return over the past year. And yet, despite that monumental climb, there is still a 15% short interest looming over the equity. It is, by all technical definitions, a highly explosive setup. So based on this company's radical transformation into a multi-mineral critical supply chain hub, we have a central question today. Is Energy Fuels severely undervalued right now with a credible, data-backed path to $38 a share? Or is it an overvalued capital-diluting trap burdened by massive execution risks?
That is the multi-billion-dollar question, isn't it?
It is. And looking at the data, I see Energy Fuels as fundamentally undervalued. When you methodically construct a sum of parts net asset value, the NAV easily exceeds $25 per share. To me, this makes it a premier, deeply discounted vehicle for Western energy sovereignty.
Look, I understand the allure of the narrative, I really do, but we need to look very soberly at what investors are actually paying for today. You have a company trading at a massive 69 times trailing price-to-sales multiple and a 6.8 times price-to-book ratio. A multiple of 69 times sales is something you expect to see in an early-stage software company, not, a heavy industrial miner moving physical rock.
Well, but that multiple is looking backward.
It is backward-looking, yes, but it also shows that the market has priced this equity for absolute perfection moving forward. That valuation relies entirely on unproven, highly complex mill operations and, perhaps more concerningly, incredibly precarious African geopolitics. So while you see a deeply discounted vehicle, I just don't buy that the risk-to-reward ratio here is favorable. I see an overvalued asset with execution risks that this current elevated multiple completely ignores.
Let's look at the actual operational data we saw in 2025, because I think that helps explain why the market is willing to pay that premium. We have to unpack the uranium operational breakout they just achieved. Energy Fuels didn't just meet their baseline targets. They pulled over 1.6 million pounds of uranium out of the ground and processed it.
Which is a solid number on paper.
It exceeded the upper bound of their previous guidance by 11%. That kind of overperformance is exactly what builds institutional confidence. But the real story, the fundamental catalyst for the valuation we're seeing today, is the upcoming 2026 cost inflection point. Right now, they're integrating exceptionally high-grade ore coming out of the Pinyon Plain mine in Arizona.
Right, the Pinyon ore.
Historically, the company's finished uranium inventory carried a weighted average cost of $53 per pound. But because of this high-grade ore integration, the consolidated cost of goods sold is projected to plummet. We are talking about dropping from that historical $53 down to between $30 and $40 per pound by the first quarter of 2026. Think about what that does to their margins when uranium is hovering at these current high levels. They are transforming from a company struggling with costs into an absolute cash-generating machine.
If they hit those cost targets.
Well, if you want proof of management's conviction that they will hit those targets, look at the recent $700 million convertible note financing. They didn't just raise capital and let it sit. They took $53.55 million of that cash and purchased capped call options.
I'm glad you brought up the capped calls.
It's crucial. For those listening, a capped call is essentially a financial strategy where management buys options to mitigate the dilution of issuing those convertible notes. But the strike price really matters here.
By doing this, they effectively push the dilution threshold all the way up to $30.70. That is a 100% premium over the reference price. Management is explicitly betting, with over $53 million of company capital, that the stock clears $30. It is the ultimate put-your-money-where-your-mouth-is signal.
It's a strong signal, I will concede that. But let's take a breath and look at the immediate financial reality facing the company today, before we start counting the cash from 2026. The actual profitability, or rather the severe lack thereof, is glaring. The company just reported a net loss of $86.1 million for 2025.
Which is completely expected during an expansion phase.
Perhaps, but more alarmingly, they posted a negative $141.2 million in cash from operations. That is cash aggressively going out the door, not coming in. It takes a staggering amount of capital to keep these physical operations moving. So while you frame that $700 million capital raise as a sign of strength and liquidity, I see it as a massive lingering threat of serial dilution to the current shareholders.
How so? The capped calls protect against that.
Only if the stock behaves perfectly. The moment this company faces project delays, and let's be honest, in mining, delays are the rule, not the exception. They will burn through that liquidity. If they burn that cash and face operational hiccups before the stock ever reaches that $30.70 threshold, the current shareholders are going to be severely diluted. We also have to contextualize this valuation against their peers to see why the market might be skeptical.
You mean Uranium Energy Corp, UEC?
Exactly. Look at UEC. The market values UEC at up to $7.6 billion, while Energy Fuels sits at a $5.4 billion top-end market cap. Why the discrepancy? Because UEC is a pure play in situ recovery, or ISR, miner.
It's a completely different operational model.
It is. ISR is basically giant underground plumbing. Instead of digging massive, expensive holes in the ground and hauling rock to a conventional mill like Energy Fuels does, UEC pumps a solution underground to dissolve the uranium and just pumps it back up to the surface. It is a lower cost, it is much easier to permit, and it is incredibly straightforward. The market rewards that simplicity. Conversely, the market is rightfully and heavily discounting Energy Fuels for its multi-mineral complexity. They are trying to be a uranium miner, a rare earth processor, and a heavy mineral sands operator all at once. They're trying to be too many things, and the market is penalizing them for that lack of focus.
I think the market is temporarily mispricing them, precisely because they don't fully understand that model yet. I wouldn't frame that multi-mineral complexity as a liability at all. I see it as their greatest structural moat. Let's dig into this mine-to-metal rare earth pivot, because it directly addresses a massive, critical geopolitical vulnerability.
The Australian Strategic Materials Acquisition.
Yes, the $299 million acquisition of Australian Strategic Materials, ASM, is nothing short of strategic brilliance. Look at the macro picture here. The West has suffered from a profound processing bottleneck for years. We can mine rare earths, sure, but we have been completely dependent on Chinese separation and metallization capacity to turn that rock into usable magnets for electric vehicles and defense tech.
I admit, sidelining China entirely is a brilliant pitch.
It's more than a pitch. By acquiring ASM, Energy Fuels integrates its own oxide production at their White Mesa Mill in Utah with ASM's metallization capacity. They are literally solving the Western bottleneck. And this isn't just theoretical modeling anymore. Look at the Phase 2 expansion. That's a $410 million capital expenditure targeting 6,000 tons per annum of neodymium praseodymium oxide.
Neodymium and praseodymium, the critical components for permanent magnets.
Exactly. And they are modeling an all-in production cost of $29.39 per kilogram, which makes them globally competitive with China. On top of that, in late 2025, they achieved pilot-scale production and qualified 99.9% purity dysprosium oxide, specifically for electric vehicle magnets. They are building a fully integrated supply chain that simply does not exist anywhere else outside of China.
I appreciate the ambition of solving the Western processing bottleneck. I really do. The strategic narrative is incredibly compelling, but we have to separate that strategic ambition from the brutal, on-the-ground technical reality. My bear case here is entirely grounded in engineering and metallurgy. Let's talk about the actual plumbing of this operation.
The White Mesa Mill.
Right.
What Energy Fuels is proposing to do at the White Mesa Mill is unprecedented. Operating a conventional mill that must physically and chemically switch back and forth between a uranium processing cycle and a rare earth element cycle has never been done at this massive commercial scale.
They've run campaigns.
Pilot campaigns, yes, but commercial scale is a different beast. The chemistry involved is incredibly complex. Switching a massive industrial mill between processing radioactive uranium and refining high-purity rare earths isn't like flipping a switch on a conveyor belt. It's like trying to bake a delicate souffle in an industrial oven you just used to roast a garlic chicken without stopping to deep clean it. The risk of cross-contamination is massive.
They have engineered distinct circuits for this.
But they share underlying infrastructure, the wear and tear on the pipes, the valves, the tanks. When you are running these highly corrosive and totally different chemical processes is staggering. And then add the regulatory oversight required to manage both radioactive materials and high-purity rare earths in the same physical facility. If they experience a single significant technical upset at White Mesa while trying to balance these cycles, if a batch gets contaminated, it would instantly destroy the projected net present value of the entire rare earth segment for that quarter. You are pricing in flawless execution of a metallurgical process that is entirely untested at this volume.
I am not ignoring the technical complexity. You are right, it is an engineering feat. But we must weigh that technical hurdle against the overwhelming macro forces pushing this company forward right now. You simply cannot ignore the geopolitics of energy sovereignty at play here.
Geopolitics is a shifting sand.
But legislation is concrete. The Prohibiting Russian Uranium Imports Act is not just a passing headline. It is a fundamental, long-term structural shift in global energy markets. By banning Russian low-enriched uranium, the United States has unlocked $2.72 billion in federal funding to expand domestic capacity. This legislation practically mandates U.S. utilities to purchase from the leading domestic producer.
But does it mandate they buy from Energy Fuels?
Who else operates the only conventional uranium mill in the United States? It is Energy Fuels. They are the ultimate China Plus One strategic asset for rare earths, and the ultimate Russia Zero asset for uranium. When national defense and energy security become the primary drivers of capital allocation, when governments decide they must secure these supply chains regardless of short-term costs, standard price-to-sales multiples begin to look fundamentally inadequate for capturing true value.
National defense is a very powerful narrative. It opens government wallets. But let's talk about where the actual physical materials come from to feed this whole machine. Your entire rare earths thesis, your China Plus One moat, rests entirely on feedstock security. If you don't have the raw sand, you don't have a supply chain. And specifically for Energy Fuels, this rests on the Vara Mada Heavy Mineral Sand Project, located in Madagascar.
The Vara Mada project has incredible economics.
On a spreadsheet, yes. The feasibility study shows a theoretical $1.8 billion net present value and an internal rate of return of 24.9%. Those are fantastic numbers, but we must look at the reality on the ground. There was a coup in Madagascar in October of 2025.
The government transition is being monitored closely.
Transition is a very polite word for a coup. Right now, the entire rare earth supply chain for Energy Fuels, the feedstock for White Mesa, rests on formalizing fiscal terms and securing a monazite permit from an unproven transitional interim government. Let's pause on the word interim. When you are sinking hundreds of millions of dollars into a mining project, the last thing you want to hear is that the Minister of Mines who signs your permit might be in exile next month.
They have operated in complex jurisdictions before.
Not like this. If this new government decides to nationalize the asset to curry favor with the populace, or if they simply hike the royalties to a point where the spreadsheet economics break, the $15.26 per share of intrinsic value that analysts have assigned to the rare earth and heavy mineral sand segment literally vanishes overnight. You cannot build Western energy sovereignty on a foundation of unstable African geopolitics without pricing in a massive risk premium. And at 69 times sales, the market is pricing in zero risk.
I hear the concern on sovereign risk, but I am not convinced that the market is blind to it. I think your bearish stance ignores the strategic leadership transition that was specifically designed to navigate this exact phase of the company's life cycle.
You're talking about the CEO change.
Yes. In April 2026, we are seeing the handover from Mark Chalmers to Ross Bappu. This is not just routine corporate reshuffle. Bappu is a PhD mineral economist who spent nearly 25 years at resource capital funds. He isn't an exploration guy. He is a private equity capital allocation guy. He brings a precise, rigorous financial discipline intended precisely for this execution phase, for managing international assets like Vara Mamaleta, negotiating those fiscal terms, and ensuring capital efficiency at White Mesa.
A PhD doesn't stop a royalty hike.
No, but a seasoned resource economist knows how to structure international agreements to mitigate that risk. When you combine his leadership with the upcoming 2026 operational milestones, that path to $38 a share becomes very credible. And remember the technical setup I mentioned at the very beginning? The 15% short interest?
The short squeeze thesis.
£5 million of finished uranium, and they demonstrate positive operating cash flow from that lower COGS profile we talked about. We are going to see a massive institutional re-rating. Institutions will stop viewing this as a highly volatile speculative development stock, and they will start treating it as a core, must-own infrastructure holding. If that happens, and those shorts are forced to cover their positions, 100% gain to $38 is absolutely within the realm of possibility.
Reaching $38 a share requires a perfect, frictionless macro environment. It requires a flawless alignment of the stars. It requires uranium holding steadily above $100 a pound despite new global supply coming online. It requires rare earth prices to fully recover from their depressed 2025 lows. And, most importantly, it requires absolutely zero operational hiccups at the mill and zero political roadblocks in Madagascar.
Mining is never frictionless, but the upside potential outweighs the friction here.
Even the highest, most wildly optimistic Wall Street analyst target right now is only $34. Expecting $38 is stretching the limits of probability. That current 69 times trailing price-to-sales multiple leaves absolutely zero room for the inevitable delays in global resource integration. Bappu's financial discipline, regardless of his pedigree at resource capital funds, will be tested immediately by the sheer brutal capital intensity of maintaining an expanding U.S. mill while simultaneously negotiating with the post-coup government in Madagascar.
He has the war chest to do it. The $700 million.
But the market is not going to re-rate this stock to $38 based on guidance and a war chest alone. They are going to demand to see the actual cash flows. They want to see the money coming in. And right now, as we establish, the cash is flowing out to the tune of $141 million last year. You are asking investors to leap across a massive chasm of execution risk.
I think it's important to pull all these threads together. If you look methodically at the underlying data we've discussed today, the production beats, the legislative tailwinds, the cost reductions, Energy Fuels is fundamentally undervalued relative to its risk-adjusted net asset value. I strongly maintain that value sits north of $25 a share today.
Even with the cash burn?
Because you are building something that doesn't exist anywhere else. We're looking at a company that is uniquely positioned. It is the only fully integrated mine-to-metal rare earth producer outside of China, and it possesses the only operating conventional uranium mill in the United States. The 2026 cost inflection point, driven by that high-grade pinion plain ore, is going to radically transform their margin profile. And the capped call structure from their recent financing clearly shows that management believes the true intrinsic value of this equity is well over $30. It is the premier vehicle for the macro shift toward Western supply chain independence.
And while I absolutely agree that the physical assets themselves are undeniably unique and the macro narrative is incredibly strong, my deep skepticism remains firmly anchored in the execution risk. The combination of attempting to switch incredibly complex metallurgical milling cycles between radioactive uranium and high-purity rare earths, the severe, unquantifiable jurisdictional risks currently present with the interim government in Madagascar, and a capital structure that requires flawless future execution to prevent further shareholder dilution, it all makes the current valuation dangerously speculative.
Paying 69 times sales for a company that must successfully navigate all of these unproven technical and geopolitical hurdles is simply pricing in a reality that hasn't happened yet.
Yes, despite our different frameworks for valuing that execution risk, I think we both clearly see that the broader market is watching three vital catalysts in 2026. First, the finalization of the Vara Mada monazite permit in Madagascar, which secures the feedstock. Second, the seamless operational integration of the ASM acquisition, which proves the metallization capability. And finally, the realization of commercial-scale heavy rare earth production at White Mesa in the fourth quarter.
Yes, those three milestones will undoubtedly dictate the reality. They will determine whether the company actually transitions into a highly profitable, high-margin processing hub, or whether it becomes a cautionary tale of overexpansion and catastrophic capital dilution. The quarterly data over the next 12 months will tell the true story.
There is certainly much more to explore in the underlying numbers, and the listener must ultimately weigh the incredible intrinsic value of securing Western energy sovereignty against the stark, unforgiving realities of mining execution and geopolitical instability.
If you like this content and want to watch more videos like this, then don't forget to subscribe. Thanks for watching. See ya!